All right. Good afternoon, everyone, and welcome. Thanks for joining us for today's webinar. I'm Kristen Shirtleff, Marketing Coordinator here at SPARXiQ. Today, we have SPARXiQ CEO David Bauders here to talk about the 4 key profit levers today's distributors need to focus on in order to maximize their performance in the market. Before we get started, I'd like to make you aware that this webinar is being recorded and will be available on our website for on-demand viewing. We have a lot to cover, so if we have time at the end of the presentation, we'll answer any questions you may have. Please go ahead and type any questions into the Q&A box, and we'll be sure to address them after the webinar. And without further ado, I'll turn it over to David Bauders.
Thanks, Kristen, and glad to be here. Welcome to everybody. It's a very exciting time as we emerge from the COVID pandemic to be thinking about what are the investments, what are the key business profit levers that we can focus on coming out of this difficult period to set the foundations for growth in our businesses going forward. So I'd like to share with you today is a model that we've developed that helps distributors to make sense of the different profit levers in their business and how analytics and how core skills training can help distributors to convert data into dollars. So we'll be talking about a little bit about SPARXiQ to get started. Some of you may have known us in the past as SPA or Strategic Pricing Associates. We rebranded about 1.5 years ago to reflect our growing portfolio of solutions that we provide to market leaders. And those solutions today encompass, as we'll show today, not only the analytics of price optimization, but many other types of analytics to help distributors grow sales, improve profitability, improve their cost of goods sold, and improve the efficiencies in their business. We've worked with over 600 distribution market leaders around the world over the last 28 years, over 200 manufacturing companies. In many cases, we're working with both the manufacturers as well as the distributors to drive channel profitability and engagement. We're also the official platform provider in the electrical industry for the point of sale connection, which is the data transfer hub between distributors, manufacturers, and rep agencies. And we're providing an increasing array of platform services to help manufacturers and distributors to grow their businesses together. So what we want to talk about today is how does complexity in distribution create opportunity, but also create obstacles to profitability? And really at the root of all of distribution is what we call this market complexity challenge. So every distributor of almost any size has thousands of customers. They may have thousands of products. They may have dozens of different markets that they serve geographically or different types of customers. They probably have variable costs in many industries in terms of the cost supports or rebates that they get from their suppliers. They have very differentiated competitive environments as they move from urban to rural, across states, across geographies, across product lines. They also typically have dozens or even hundreds of vendors whose products they have to represent, selling them into diverse markets across a fragmented and often distributed branch network with dozens, hundreds, or even thousands of sales reps. So when you consider the complexity of these businesses, how many personas are involved, how many vendors, how many customers, the sheer fragmentation and complexity of this business, it lends itself to a lot of difficulty in terms of optimizing profitability. So one of the ways that we like to make sense of profitability, we talk a lot about profitability, and what we mean by that is net profitability, not gross margin dollars, which is a very different idea. When we start to think about what is the profit dynamics in a distribution business, we see what we call the whale curve. And this is a term that may be familiar to some of you, but I'll go through it briefly to explain the concept of the whale curve. So the whale curve takes all of your customers or vendors or branches, sales territories, et cetera. It takes the best of those, the most net profit producing customers, et cetera, and starts building them up from highest profitability to least profitability. And what we discover across hundreds of distribution businesses that the first 20 to 30%, the best 20 to 30% of your book of business produces between 150 and 300% of your actual net profits. That is, if you're a 4% EBIT company, you could be a 6 to 12% company when you've reached peak profitability before you take on money-losing customers and money-losing product lines, branches, territories, et cetera. There's a middle group. So the first group we call the profit makers. And then there's the middle of the pack, which is more or less sustaining peak internal profitability. And we call these the profit neutrals. They're sustaining, not contributing to or detracting from peak profitability. And then the last 20 to 30% of business, whether it's customers, vendors, sometimes branches, sometimes territories, that money losing segment when it comes to net profitability typically sacrifices between 33 and 67% of net profits. So the average wholesale distributor with a 4% EBIT could actually be a 6 to 12% EBIT before they take on those money losing market segments. And so the big question becomes, what's driving customers or product lines or branches to be particularly profitable, and what's causing the profit leakage, the profit drains on the far right that bring us down to a much lower level than we could have possibly earned. So we have a framework that we call the distributor profit diamond. The profit diamond really organizes 4 key levers that every distributor needs to master if they want to be a modern, value-adding, viable, and able to invest in the future distributor. So there's obviously pricing. Many of you know SPARXiQ from our pricing heritage. But we also know that customers cherry pick and quotes don't get converted. There are opportunities to sell to customers in the marketplace, and they intentionally split their purchases across multiple suppliers. And so frankly, for most distributors, they have big gaps in the share of customer wallet that they're getting, or the share of the customer's wallet that they're even quoting. So sales performance is another key opportunity where a lot of leakage occurs in these businesses. There's also cost of goods sold. So in certain industries like electrical, plumbing, HVAC, fluid power, power transmission, many other verticals, vendors are providing cost supports into the COGS of their distributors to give them special pricing on certain customers, projects, or other opportunities. And what we've seen is that COGS support that you get from vendors, if you're in one of those industries, is a critical lever to driving not only share of wallet, but also driving profitability. Then at the bottom of the profit diamond, we have cost to serve. And this is really about how we engage with our customers, how they behave, and how we serve them given how they behave. And it answers the question, are we serving them efficiently? Are we able to generate enough gross margin dollars to offset the cost of serving those customers and generate a respectable profit? So these 4 levers are all critical. And as you can imagine, there are a lot of interdependencies between pricing and sales performance. For example, if we identify products where we're not generating good share of wallet, what should be the dynamic pricing strategy to help convert that opportunity? Or if we're not generating enough profitability from our pricing, are there opportunities to go back to our vendors and generate additional cost support? And which vendors and how much cost support could we get, given what the data show us? Or given the way that the customer behaves and the way that they serve us, how should we serve that customer? How should we price that customer? What kind of cost support should the vendor give us given the costliness to serve a particular customer? So these areas of opportunity are not only independently valuable, they also have synergies and interdependencies among them that make it extremely valuable to approach them from a unified perspective. Let's go into those a little bit deeper. We talked briefly about the whale curve. You can see that in the upper right. We know that the whale curve, what's driving the whale curve with our profit makers, profit neutrals, and profit drains is always going to be the intersection of these 4 variables. How much revenue we get, what kind of price we get from the customer, how much cost support we get from the vendor, and the net cost to serve of that customer. So as we look around the diamond, we can see in the sales quadrant, for example, one of the big questions is, why don't we add more new accounts? Why is our revenue stagnant? Why does it seem to be that we have the same share of wallet year after year after year? What would our sales team need to do differently? What skills would they need if they were to sell more to our existing accounts and to prospect and hunt more effectively for new business? And how could we improve our quote conversion rates? We see for most distributors, they lack an effective or consistent process for nurturing the quotes that their teams generate. They end up converting very poorly on those. They end up failing to add in products that could boost the value of those quotes, and their conversion cycles are frankly pathetic. So as we think about sales optimization, it's extremely important to understand all of the different levers to grow sales with new customers, with existing customers, and through the quote process. And analytics can help us to spot where are those opportunities? Where could we sell more to our existing accounts? How could we add lookalike customers who would perform like our best profit-making accounts? And how would we convert the most valuable quotes that we have out in the marketplace to revenue? On the pricing side, we know that analytics are extremely important with thousands of products, thousands of customers, millions of pricing permutations. Every modern distributor needs a true data-driven price optimization solution. And fundamentally, if we want to be great at selling, we also have to have a pricing strategy that supports it. In the upper left, the cost of goods sold. This is really where distributors in certain verticals have huge opportunities in many industries. A big chunk of net profitability comes from vendor cost supports and rebates. And what we see when we look at those vendors costs that they provide into the channel is they have the same variability and inconsistency in many cases that distributors' own pricing has to their customers. So fundamentally, being able to identify which accounts need extra cost support because they're profit drains, which vendors and product lines are not getting cost supports that should be getting cost supports. How do we add in products to vendor price support quotes that are missing from those today? And how do we make sure that every customer who should be getting cost support is getting proper cost support? That variability of cost of goods sold is a critical profit lever in distribution in certain vertical markets. And then finally, in the cost to serve quadrant, understanding what is the true cost of each of our customers to serve? What's the true cost of each of our vendors to serve? Being able to really pinpoint net profitability at the customer, vendor, product line, branch level, sales territory level. All of those insights are critical to being able to manage the other levers in the profit diamond. So at the end of the day, we want to have a Six Sigma approach to identifying who are those unprofitable accounts and what are the underlying root causes in the diamond framework that we can remediate in order to close that value gap. So as we start to apply the profit diamond concept to 3 different accounts, for example, let's say we're picking a green account, a yellow account, and a red account from the whale curve in the upper right. What we find is that those accounts are green, yellow, or red based on their performance in each of those 4 profit levers. And assuming that COGS is in play in an industry where that's in play, we see that each of these levers, as they are pushed away from the center towards the best or optimized values, contributes to an account's profitability. The better the pricing, the better the share of wallet, the better the COGS support from the vendor, the more efficient the cost to serve, the more profitable that account will be. So we want to start to understand it and quantify and measure for each of our accounts, and frankly, for each of our vendors, branches, et cetera, is what does their diamond plot look like? And how do we start to identify where the gaps are at each account? So in the first account, you can see they have a cost to serve problem. Their pricing, their COGS, and their share of wallet are looking pretty good. They're in the green. However, their cost to serve, the way they order, the way we cover their needs, the way we serve them in the marketplace is inefficient. And it's driving them to, even though they're green overall, they have a gap in their efficiency of service. In account number 2, for example, they're now having a smaller area of their diamond. You can see the yellow area. They're underperforming in pricing, underperforming in share of wallet, underperforming in COGS, and to a lesser extent, underperforming in their efficiency of cost to serve. So what we're doing is we're measuring for each account how effectively we're performing each of these 4 attributes. And then the third case, we can see, obviously, for a red account, they're going to be suffering in a lot of dimensions here. The pricing pain is the most acute. You can see it's closest to the center. We can see that close behind that are the cost to serve and the COGS. And the 4th opportunity in terms of value is the share of wallet. So once we start to identify and measure the profitability of these accounts and their performance of each of the four attributes, we can start to identify what will it take to remediate those? What would it take to take a red account and move it into yellow, or a yellow account and move it into green? We now know which levers we have to focus on in order to accomplish that shift and to unlock that 50 to 200% improvement in operating profitability. As a side note, we can also start to incent our sales teams or our branch teams and pay them differently based on whether accounts are green, yellow, or red. As we start to present them with the campaigns to remediate these situations, we can reward them as they move accounts out of the red into the yellow or the green. So we've shown you briefly what's driving this. It occurs not only at the customer level, it also occurs at the vendor level or branch level. And we can see each of these different types of accounts is really what's driving this leakage of profitability away from the 200% line down to the actual 100% that was achieved. So a company could very well be an 8 or 12% company, but because they haven't moved the yellows and reds towards the green, they're sacrificing a third to 2/3 of their profitability. So in terms of how much opportunity we see across the corners of the diamond, they have very different, let's say, magnitude of change that we see possible. On the sell price side, distributors who focus on pricing, who have effective price optimization solutions in their business, quote optimization solutions in their business, can broadly improve their performance by 2 to 4 margin points. So if you're a 4% distributor and you get a 2% overall price optimization benefit, that would be a 50% improvement in your operating profit. When it comes to sales volume, we see that converting our quotes more effectively, finding add-on products to put into quotes, finding the missing cherry-picked products that customers are buying from our competitors, boosting consumption of other products, overdue SKUs, products that are fundamentally in a replenishment mode, being able to spot and remediate the leakage in revenue, we tend to be able to increase that by at least 10%. So that for a typical distributor would contribute to a 46% improvement in operating profit after accounting for cost of goods sold and the cost of serving customers. We look at those industries that have variable cost support, like the sell side pricing opportunity on the COGS side, which I call a buy side pricing opportunity. We see, broadly speaking, that we can generate an additional 2% benefit and cost support from our vendors, 2% of revenue. So that would be worth broadly about a 35% improvement in operating profit if you're in an industry where COGS is in play on a daily basis. Then we look at the operating expense lever, that one typically by changing service models, improving the way we go to market with certain customers and or pointing them to more efficient platforms like e-commerce, we can reduce operating expenses by at least 5% of sales, which is worth about a 33% improvement in their operating profit. So each of these levers is valuable. The impact that you can generate in any given corner varies quite a bit, but broadly speaking, as you can see, we have the forces at play that could easily double or more the profitability of a distributor. So a lot of this comes down to what we call the core sales skill of strategic account management. If we have our sales teams managing our customers with the right insights into profitability, the dynamics of profitability across the 4 levers, we can start to build the disciplines with our sales teams to actually maximize and optimize each of those levers and boost profitability. So it comes down to having a certain core strategic account management discipline in our sales team, which is part of a more robust sales management operating system. So price optimization for many companies remains a large opportunity. They're stuck using Excel pricing matrices. They're using DIY tools that they've developed 5 years ago and just keep rolling over year after year. What we find when we look at the data is we see significant underpricedness of small accounts. So if we show the revenues of each of our customers, each customer is a dot on the horizontal axis. We show how much they spend with us and or their potential. On the vertical axis, we show their actual price levels of their market basket compared to similar customers. We see a vast amount of pricing dispersion. And frankly, it's the smallest customers, those who are transient, one and done customers, who are most likely to be leaking price, as we can see in the lower part of this bell curve that's turned on its side. And if you think your company is unique in this opportunity, you're wrong. We've looked at hundreds of companies and they all fundamentally have bell curves turned on their sides with lots of pricing leakage. And until they move beyond Excel into true price optimization tools, they're likely to keep leaking price into these small accounts. And again, it's typically worth 2 to 4 margin points. A lot of companies have Wild West pricing of their customers where every sales rep puts their hands on it. They get to try to figure out what's sensitive, what's not sensitive to the customer. What we see within a single customer's market basket is when we evaluate the sensitivity of that product, what we call the coreness of it, with the most sensitive products being at the left and the least sensitive being at the right. We see that while our sales teams are pretty good at getting paid on the A and B items, they're managing it relatively tightly. They're failing broadly to get consistent premiums on the C and D items, the long tail of low volume, low sensitivity spend of those customers. You can see the slope of the regression line here shows barely any premium overall between A's and D's. And you can see in the lower right, large volume of low sensitivity products that are just underpriced. There's also the phenomenon, of course, of peanut butter pricing and cost plus. Over and over again, we see sales teams that purport to be pricing according to market conditions and what the market will bear. However, when we look at the actual gross margins that they're delivering, they not surprisingly show up having margins ending in zeros and fives. And we know that the marketplace does not price according to gross margins. So what this tells us is basically this histogram is showing us the ratio of cost plus to market-based pricing in a company or a territory or branch. You can see the magnitude of the red bars here is showing you just how much cost plus is going on in these businesses. So that Wild West approach to pricing predictably produces what we call the cost plus or peanut butter pricing approach. So how do you start to move out of Excel spreadsheets into a more holistic data-driven pricing system? This is the great challenge for companies that thought they had pricing under control. It starts with really extracting critical data sets around quote realization, quote conversion data, invoice and transactional data, contracts data, organizing all of these data into a cohesive data set that helps us understand the true dynamics of price sensitivity and elasticity in these businesses. But we know in order for the sales team to be able to execute, we also have to bring market assessments into it. And this is really where the management team helps us with understanding competitive dynamics, understanding the dynamics of roles within the sales force, inside sales, outside sales, strategic accounts. All of these different layers have to be addressed, and we have to think really strategically about how do we take the data that we have available to us and align it with the market opportunities and come up with actionable customer and product segmentation. And ultimately, when we type in a customer number and type in a SKU number, we have the dynamic pricing that will optimize revenue and optimize profitability. So price sensitivity is something a lot of people are thinking about when they are setting prices in the marketplace, but most of the time they don't really have a good grasp on what drives price sensitivity. SPARXiQ over the last several decades has been working aggressively to understand what is it that really makes customers price sensitive. We've identified a large number of attributes that when considered individually and in their totality can help us to understand where is the price sensitivity in a customer's book of business or in the sensitivities within a quote as we start to quote to our customers. It's things like what is the order size? What's the repeatability? What are the relative volumes across products? What is the frequency or average order size? How much variability of price is there? All of these can vary from customer to customer, from sales rep to sales rep. And so having a coherent, cohesive system that can grab all of these attributes, unify them, and come up with best fit assessments of price sensitivity is the key to making sure you're competitive in your e-commerce platforms, that you're competitive with the customer's most visible top market basket products, but also that you're capturing premiums on the high cost to serve, low visibility convenience products that customers buy. Without a system to do this, as we saw before, sales teams predictably sacrifice margin without capturing revenue. So there are a number of attributes, as we talked about, that can help us to determine customer sensitivity. A proper pricing matrix always brings in customer potential, and not the customer potential that the sales team tells them, but the true firmographic estimate of customer size that considers their existing spend patterns, similar customers, peer-to-peer analysis across market segments, and identifies not only how big is that customer, but what does their market basket look like and what pricing will it take across their market basket, not just their existing spend, to actually maximize share of wallet. We also like to look at which types of customers, what's their go-to-market, what is their cost to serve. There's also can potentially be issues around regionality, geographies, things like that. So as we start to build out a framework for how to integrate price sensitivity with customer sensitivity and segmentation, we end up with what we consider to be a cube visualization of what's going on. It's obviously more dynamic than a simple cube, but the cube helps us to visualize how the intersection of a customer segment and sensitivity rating, along with the sensitivity of the products that they're buying, can differentiate pricing around the different areas of the market mix. And it's really this approach to price segmentation and analysis that helps companies to raise their margins and to drive greater share of wallet with their customers. So a lot of companies are really have experienced flat profits year over year. And as we head into an inflationary economy with the Federal Reserve committed to 2% plus inflation, we have vendors now pushing double-digit cost increases to their supply channel partners. It's a great time for distributors to rethink how they optimize their pricing. Many companies have had flat EBIT year over year for decades. You can commit to price optimization, get your analytics in place, integrate it directly into your ERP system, make sure it's truly a multivariate dynamic pricing system. You can consistently generate 1 to 2 margin points, which would typically make a 4% company a 5 to 6%, $1 to $2 million per 100 million of revenue in additional profit. Next, we'd like to turn our attention to the mirror image of the sell side pricing opportunity, which is the buy side vendor costing opportunity. And this is an area where, not surprisingly, in certain industries like electrical, like plumbing, HVAC, fluid power, power transmission, anywhere where there's significant variability around vendor cost supports, there are big dollars to be gained from understanding the optimal cost supports from different vendors to different types of opportunities, sales opportunities. So the big questions that we're thinking about as we get into this area are we getting the best cost from our vendors, or are we just getting what we need to escape the minimum margin problem that our company has set? Have we identified and quantified which profit drain customers for each vendor we should be getting additional cost supports above and beyond the usual cost supports in order to remediate losses with those accounts? And have we truly taken a data-driven approach to consistently getting the best cost supports from our vendors and backside rebates that the data show that we can get and that we already get from some of our best supported customers and product opportunities? What we see as we look at the data is, once again, bell curves turned on their sides. We see that 3 different branches buying the same products day in and day out from the same vendors have very different costs that they're getting, not only within their branch, but from one branch to another. We see that for those companies that have a significant level of branch level sourcing or project or end customer level cost supports, that the vendors have very inconsistent practices, and not only across branches, but even within branches. What we work with our clients to do is to identify which end market opportunities are getting too little cost support today, given the variability that we see in the marketplace. So just like the sell side pricing opportunity, there are excellent buy side pricing opportunities for distributors who leverage data and have optimization algorithms to identify where they can improve. And we see this over and over again. We see it in many of the commodity product categories. For example, there may be 5 different vendors who are producing a similar product, and the sales teams on a daily basis don't know which products they should be quoting. They're quoting the high cost products instead of the low cost products. And this variability across different vendors in commodity categories costs distributors a lot of money. The second example is more of a, let's say, a regional distributor type of problem where they've got different branches. We're showing you each of the branches, what is their cost level that they're getting across those different branches for the same product. And once again, we see that big differences in price, 10%, 20%, 30%, not 1 and 2%, but big numbers in terms of the variability of costs across those branches. So when we want to think about how do we get better cost from our vendors? Just like we did with the pricing, the sell side pricing problem on the buy side, there's really three key attributes that drive the COGS optimization. The first is the leverage with the vendor. How much variability in cost does a particular vendor have in the markets that we serve? How much extra discounting goes on? How important are we in their ability to connect with end customers? The second is really around profitability, and that is, where are we making money? Where are we losing money? And how does that profitability compare within our vendor pyramid of products? Can we identify those money-losing vendors where we can ask for and achieve better cost supports? And the last is really the cost to serve a particular product line. As you work your way from the top of your vendor pyramid to the bottom of your vendor pyramid, the cost to serve varies radically. Inventory turns fall. The amount of restocking and bringing things in and having to send them back out to customers, all those handling costs. With the bottom of the pyramid, those costs are significant. In many cases, those costs need to be remediated by better cost supports from the vendor. But without the ability to measure the effects of that, it's very difficult to get those cost supports back from the vendors. So what's it worth? Just like on the pricing side, broadly speaking, about 2%. And when you factor that by the typical distributors, let's say 70% COGS as a percent of revenue, it's worth about 1.4 margin points to the bottom line. So whereas we could get from 4 to 6 on the sell side price optimization, we can grab another 1.4 margin points, 140 basis points, by optimizing COGS in those industries where COGS is consistently in play. Moving our way around the diamond, we're now at the top of the diamond, which is really sales performance. And the first thing to observe about sales performance is just how much variability there is across sales teams. As we compare the top quintile or top 20% of sales reps within a distributor to the bottom 20% of sellers, controlling for customer mix, controlling for product mix, we see the best 20% of sellers consistently deliver 10 extra margin points. They deliver almost twice the customer retention of their customer base and about 6 times the share of wallet. So if we want to have great sales performance, it starts with identifying what are the DNA traits, what are the competencies, what are the daily behaviors, what are the insights of top sellers that allow them to outperform? How do we clone their performance? By building a sales system that predictably gets similar performance from all of our sellers. So there's a bunch of sales performance issues that get brought into this, but for now, we'll just focus on some of the data-driven questions. Do our sellers really know, our frontline sellers know, the true profitability and market basket profiles of their customers, beyond just knowing what the general product categories are and whether they think they're getting a lot or a little? Do they actually know which products their customers should be buying from them on a particular quote in their flow business, stock and flow business? How do we arm our sellers with the insights at order entry, at quote level, to make sure that they're asking for and appending those logical tag-along products that should be in the customer's market basket? Are they able to consistently grow their existing accounts? Do you see that the share of wallet is growing in your book of business over time? Are the sellers converting data into account level sales growth and account level share of wallet growth? Does the sales team actually know when accounts are at high risk of defection or shrinking? And do they get timely alerts that help them to remediate those? These are all critical things that great sales reps do well, that many of the other sales members either don't have the insights, they don't have the skills, they don't have the awareness to accomplish. So creating systems that help to standardize and homogenize how sales reps get access to these insights and get prompted to take action becomes an important part of closing the performance gaps. One of the big questions distributors keep asking these days is, why don't our sales teams add more new accounts? Is there call aversion? Do we lack the hunting skills? Have we hired more farmers than hunters? Why aren't we getting the organic growth in new business that we should? Even when we quote new business, we fail to convert it. Why are we not getting what we should? and which new account prospects that we're getting in have the best fit characteristics that would actually grow profitability. So we think back to the whale curve. We don't want to be prospecting for accounts that have red and yellow characteristics. We want to know those that will predictably produce green in the whale curve. So how do we start to profile prospects in the pipeline to find those that actually are worth converting, knowing that perhaps 2/3 of them will not be worth converting? And do our sellers really have the daily insights and critical skills to consistently and predictably increase share of wallet? Do we have a KPI that shows us that that's happening? And do we have the right incentives and the right tools in place that will predictably convert those and increase those share of wallet statistics? A lot of it comes down to understanding the dynamics of growth. And what we like to do at SPARXiQ is give our clients very clear metrics that show how much, let's say, transition or turmoil is going in their revenue in any given year. And what we see over and over again is that there's a tug of war going on at the territory level, at the branch level, across the company. There's new accounts that are inbound at the far right. Many distributors have transient customers who come in. They may very well show up as lost customers in the next quarter, the next year, if there's not a process for nurturing them and converting them. And then there's a tug of war that's going on between the accounts that we keep year over year that are growing versus those that are shrinking. In this case, we have a happy story where the growing accounts are outperforming the shrinking accounts. But as we look down below, we can see that there's actually interesting opportunities with all of these. With the new accounts that were inbound, for example, did we have the processes and tools in place to quickly identify the most valuable new customers and start them onto a nurturing campaign? Or on the accounts that have defected, what is our process for predictably and consistently trying to recapture or salvage those accounts? And then in the middle, which is the day-to-day business, are our sales teams predictably growing revenue with more of their accounts than their shrinking revenue? So a lot of it comes down to what kind of insights do the sales team use on a daily basis? What kind of call planning process do we link to those insights in order to prioritize how they spend their time? Who should they talk to today about what to drive the dynamics of growth? Now, there are a lot of great opportunities once we get transactional data from a company to be able to understand within their customer base, where are the opportunities to grow revenue? Sometimes there are products that are replenishment oriented. These products may be overdue in their order patterns. We can spot the frequency with which customers buy them and start to prompt them at the right moments to make new purchases. Either they're overdue or they're approaching being overdue, et cetera. Or maybe they're not consuming as much as they should. Maybe they're cherry picking and giving us some of their spend and leaving some of it with the competitors. Being able to quantify that by product line, by customer, is critical to being able to give the sales teams the insights they need to prioritize upsell opportunities. And then, of course, there's cross-sell opportunities. These are the classic A-B relationships between peanut butter and jelly and bread, for example, and making sandwiches. So understanding, looking through the data, what are the missing products that a customer could be buying but isn't buying, and helping at quote time or at order entry to be able to suggest those products and make sure that they get onto the ticket and raise the average order value. These types of analytics, they can't be Power BI tools. Anybody who's counting on a Power BI tool to change the behaviors of their sales team will be disappointed. So we really believe in pushing these opportunities directly into workflow, into order entry, into the quoting systems in order to help the sales team have the visibility into where are those opportunities anytime they're looking at a particular customer. We've also discovered recently how much value there is in understanding the quoting process. For many distributors, a severe pain point is that their sales teams, their inside sales teams or outside sales teams on a daily basis are creating hundreds or even thousands of quotes per month that they're pushing out into the marketplace, but they're not fundamentally nurturing or converting those. There's no follow-up or no follow-through on that process, which leads to a lot of revenue leakage in their businesses. They already have customers reaching out to them who believe that they can solve a problem for them, but they're not reliably and consistently converting those opportunities. So a lot of companies start out by asking the question, what is the total addressable market at a customer that we can provide? which of the products do they buy and what quantities could we sell. But the only part that they usually see in their own data is the quotes that they've won. If they have a good closed loop quoting system, they can see what they won and what they lost. They may also be able to see through their flow business, the stuff that's ordered without a quote, which products were sold, but they have a hard time inferring what was the cherry picking that was going on in the flow part because there's no quote that's put to market. But the biggest opportunity that we've seen over and over again is that many distributors aren't even quoting enough of the opportunity at that customer. And so one of the things that SPARXiQ does is we work with distributors to start creating inorganic quotes. That is proposals for accounts that are actually based on identified market spend opportunities that the customer has not brought to the table to be quoted. The other big opportunity is bringing in all of these won and lost quote opportunities into the sales process workflow, and then starting to bring them into digital marketing campaigns to start harvesting all of the quotes data and bringing it into the sales funnel and marketing funnel. And that produces much more revenue, much more new organic growth. Where do we get all of these? We rely on a bunch of different data sets, which most distributors have that cover their quotes data, their POS data, rebates, drop ships, any of their direct business that they may be serving on behalf of a manufacturer. We leverage these data sources in order to be able to identify what is the total addressable market, et cetera. So improving revenue, again, we see it's worth about 180 basis points in EBIT from expanding share of wallet with customers, given the average margins of a typical distributor. So as we build our way around the diamond, we're seeing, again, significant opportunity for profit improvement. The last piece of the puzzle is really cost to serve. And this is where a lot of distributors may have dabbled in the past. They may have done ABC costing or something like that, but they generally haven't converted those insights into changes in their pricing strategy, changes in their service models, changes in how they get cost support from their vendor, or how they decide which accounts to grow their share of wallet with. So fundamentally, if we want to maximize profitability, we need to understand true cost to serve. What we see over and over again is that dynamic of the whale curve, which shows that a lot of accounts, while they may have positive gross margins, they're actually net negative at the operating profit level. But more to the point, we need to be able to understand which of the 4 profit levers is actually causing specific accounts or vendors to be unprofitable. And then the critical money question is, what is our daily workflow or remediation playbook for unprofitable customers and vendors? And how do we make a Six Sigma closed feedback loop workflow that will predictably identify and remediate money-losing customers and vendors? So the types of campaigns, if we think back to the whale curve, if we're going to shift reds to yellows and yellows to greens, there's a whole bunch of what seem like minutia that are actually driving the profit draining customers into those categories. Things like returns and allowances, customers who abuse returns and allowances or break boxes, break typical stocking quantities of product. It could be an inbound and outbound freight recovery problem, where the customer is we're failing to capture the appropriate costs of inbound and outbound freight. We see in many cases the minimum order quantities, either at the order level, at the SKU level, are insufficient to generate a profit. And there's no strategic rationale for why they should not have a minimum. It's simply a failure to identify what is the break-even value for that particular product or order level to make money. The sales coverage model, do we really need an outside sales rep that we pay 5% commissions to, covering an account that only has 4% net profit? That's taking up over half of the profitability of that account. Should we move that to more of an inside sales coverage account, or perhaps we have a hybrid model with a lesser reliance on the costly outside sales team? Or can we get them into more of an e-commerce buying habit with us, which will lower our fulfillment costs and sales coverage costs? Stock versus drop ship. This is critical. A lot of companies are stocking products they shouldn't be. They're also failing to stock things they should be. Their inventory policies are fundamentally leaving a lot of money on the table. And unfortunately, the cost to serve of order fulfillment is suboptimal. See slow paying customers, particularly during difficult economic times or even during fast times. You have new companies coming in and going out of business. We see payment terms as being a critical issue in the industry. See a lot of companies dedicating inventory to unprofitable customers and having specific inventory for those customers, which of course makes it very hard for them to remediate profitability. And then excessive drains on engineering requirements. We see over and over again a lot of end customers who are not paying enough margin to support the technical resources we're providing on their behalf. One of the most startling statistics that we see in the data is just how much money losing invoice activity there is in the marketplace. Here we're showing a client of ours that had $135 million of revenue. We're showing for every invoice line item they sold, this is at the quantum costing level, what was the net profitability? What was the cost to serve of those products as a percent of revenue versus the gross margin dollars that were generated? What you can see here is that approximately, if we look at by invoice line items, they had 766,000 invoice line items. 400,000 were profitable, 360,000 were unprofitable. They were actually losing money. Their margins were less, their gross margins were less than their cost to serve. You can see that this is a company that, while they ended up making $4.9 million, we'll call it, in net profit, they were actually a $16 million net profit company before they took on $11 million worth of money losing customers and products. Why did that come about? It came about because their most profitable accounts averaged only a 7.9% cost to serve as a percent of revenue, while their least profitable money losing customers averaged a 55% cost to serve. That is, if the sales team had given a 50% gross margin on average for this book of business, they still would have lost almost 6 margin points. So what we're seeing here is the tug of war that goes on every single day in every branch and every order desk between profitable and unprofitable orders. If you start to remediate these unprofitable products or start to shift them to your competitors, then you can start to become a more profitable company. So we like to organize campaigns that help companies understand where is the profit dynamic in their business, how many of their customers are high profitability, high potential accounts, which of them are profit draining accounts, which of them are small accounts that are profit drains versus small accounts that are actually quite profitable. How do we help them to understand which are the most important campaigns they need to run across their branch teams to be able to optimize profitability? These are all of the prescriptive campaigns that start driving the change in behavior that remediates those defects. So we can even start to do the same approach with our vendors. And what we really want to understand is what are the margins that we earn with our vendors versus our cost of serving those vendors. As we work our way across the vendor pyramid from our best vendors to our middle of the pack vendors to our least vendors, we see once again dramatic money losing vendors at the right side of the curve. And if we can start to identify those, change how we serve those to customers, change the terms of trade between us and our vendors, we can start to flatten out and reduce the losses to recapture more of our peak internal profitability. But again, it comes down to having the data and then having the workflow behind it to convert the insights into daily behaviors that improve profitability. So we talked about workflow, and there's really a few key types of workflow that we see emerging from these analytics. There are branch operations, which is focusing on things like returns and allowances, how to manage and recover inbound and outbound freight, how to shift the burden of those freights among customers and vendors, managing minimum order quantities, order fulfillment policies. There's literally a dozen different campaigns that are cutting across the operations teams and managing cost to serve. With the sales team, a lot of it comes down to the sales coverage model. What level of sales resource, how much call activity should there be? What is the mix of call activity that will make that account profitable and growing? And what kinds of pricing adjustments may need to take place if the account is not not profitable. It may need, and we can't change the way that they're behaving from a cost perspective. We can't get better vendor cost supports. We need to make proactive pricing adjustments to the tail spend of that account. There may also be slow paying customers. There may be customers with that customer specific inventory that's dragging us down. It may be their drain on engineering resources. So we really need to think about how do we allocate resources in a way that's commensurate to the profit and the gross margin dollars that an account generates. Then finally, we have sourcing and purchasing. Again, this varies from industry to industry, distribution vertical to another. And it's really about making sure we're getting best cost supports for end customers and end projects. And again, not just asking for what we think we need to meet our minimum margins, but seeing what are the possible cost supports across the enterprise and making sure we're getting the best ones. And how do we make our purchasing line up to support getting our best backside rebates? How do we convert share of wallet in order to attain those backside rebates? And then of course, freight policies are critical as well. A lot of distributors don't really understand at a granular level which vendors are dinging them on freight and which ones are they getting good terms of trade. And similarly with stock versus drop ship, it's critical to know which products we should be stocking, which ones should we boost inventory, and which ones should we cut from inventory and fulfill through drop ships. So these are all great opportunities. As we said, it's easily possible to more than double the profitability of a typical distribution business. The key is understanding the root of the problem is typically analytical. So we need to get data. We need to get strong, robust, consistent data from quotes, from invoices, from SPAs and rebates, et cetera. All of those data feed into our system where we can evaluate across the diamond, what does the whale curve look like? Which customers and vendors are green, yellow, and red, and where in each of the 4 points of the diamond are they underperforming? Once we've identified the prescriptive actions that will remediate each of those situations, we then need to push them into workflow that will create a closed loop system where the individuals who are empowered to solve those problems predictably do so on a daily basis. And that is the Six Sigma approach to driving profitability. So we maintain scorecards with our clients that help them to see for every one of the customers they sell to, what is the share of wallet that they're getting from that account from low to high? What's the pricing performance in terms of their customers' market basket pricing compared to prescribed pricing? And how does their profitability, considering cost to serve and the COGS from the vendor, land them? Are they green, yellow, or red? Where do they fit into this? And how can we start to visualize a branch, a territory, or the entire company in terms of how we're creating or destroying profit in the business? One of the things we like to do is organize playbooks to help each of the sales teams or the operations teams to be able to move each of these accounts closer to being a dark green account in the whale curve. So in many of these different quadrants, there are different playbooks for how to resolve those, and we push those into workflow. So if you think about what happens if you master the diamond, this is really the big picture here. If you can achieve each of these numbers, improve your sell price performance by 200 basis points, get 10% better quote conversion and share of wallet from your customers, on average, improve your COGS, if that's in play in your vertical, by 200 basis points, and reduce your OPEX by 5 margin points, you can turn a company that is a 4% EBIT company into a 10.5% EBIT company. And we have seen this happen over and over again. Private equity companies are keenly focused on these types of arbitrages, buying it a 4% company, turning it into a 10% company. And this will predictably change the enterprise value by over 260% if you accomplish that. So a company that's doing $100 million at 4% EBIT might be worth $28 million if there's a 7x EBIT multiplier. By the time they're up to $10.5 million, they're over a $70 million. So from $28 million in value to $70+ million in value. So that's the type of benefits that come to companies that adopt a data-driven, workflow integrated optimization strategy. We know from the whale curve that it's possible. It's consistently 150 to 300% peak internal profitability. And we learned in the last chart where it falls. So you can see the magnitude of the opportunity for companies that commit to and sustain these types of improvements. Of course, what happens as you start to optimize across the diamond is you end up with a different shape of what we call a peak optimized profit curve, which is of course much greater than your original peak internal profit curve. And of course, the end point of the optimized profit curve is commonly above what the peak internal profit was historically. Every company really has to choose what is the path that they want to be on. Are they really a data-driven optimizing company, or are they just muddling along? And really, this is where the choices that companies make drive their performance. So as you think about where your company is today, think about each of the quadrants and how effectively you're leveraging data on a daily basis to optimize performance. And the scale of how well you're doing this, we call this a maturity scale. If you haven't done anything with data, and or there's no platform for how to address these things, you fall in the none category. You're not doing it all. It's really not in play at your company. If you have a few people who are trying to do things on, let's say they're using Power BI and they're dabbling in things episodically, we'd put you at the random point on any of these levers. If you have many people doing it, working on it, looking at data, trying to make a difference, but it's not formalized, it's not systematic, there's no clear process or KPIs, that would be the informal level. As you start to have KPIs around a given point on the diamond, then you have formality. You have defined what success means and you're measuring performance against it. As you start to build the system that consistently improves the metrics of success, you have a systematic level of maturity. And as you start to be able to replicate that around the diamond and across businesses, across market segments, you have now a scalable maturity level. And then at the highest level, you're adaptive and dynamic, and you're able to not only optimize each of the points in the diamond, but they are codependent, internally linked, and they're being optimized holistically. So for companies that are interested in pursuing any one of the points on the diamond, or perhaps exploring the diamond in its totality, SPARXiQ could be a good resource for your company. We bring together the analytics and the tool sets that help you to make sense of your opportunity, to quantify it, make sure it's a data-driven approach. We understand the workflow processes that need to be mastered to drive the results. We have a particular focus on training to improve performance. And we also are well aware of and involved in helping companies to adapt incentives to support the change management that we seek. So hopefully this has been helpful for you. We do see great opportunity coming out of COVID for companies that commit to it. This can be a great platform for the 2020s, and we'd be happy to talk to you. So you can visit us at SPARXiQ.com to learn more. You can also reach out at hello@SPARXiQ.com and we can start a conversation. So glad to have you here today.